Good day and welcome to this webinar brought to you by Satrix. My name is Gielie de Swardt and I head up the retail distribution function at Sanlam Investments. And with me for the session, I've got Kingsley Williams, the CIO, as well as Nico Katzke, the head of portfolio solutions at the Satrix business. First up, you would realize that we're changing the format of the session and we are moving away from a formal presentation style into a more of a Q&A type engagement. We would really like your feedback on your experience with regards to the change of format, as we would like to improve your experience as the audience. However, the normal house rules do apply. Although the session is pre-recorded, please utilize the Q&A functionality at the bottom of the screen to ask us questions live, because while you are watching this recording, all of us are behind the scenes available live to answer any potential questions. As per normal, we've also applied for CPD points. Just keep in mind that you need to stay online for the full duration of this session to qualify for any potential CPD points. Gentlemen, welcome. Let's start our session. Kingsley, I'm going to start with you and kick off with a bit of a business update. Can you give us an idea of the recent developments at the Satrix business?
Yeah, sure, Gielie, thanks. So the most important change we've had is the appointment of our new CEO, Fikile Mbogota. She joined us at the beginning of June, and it really marks the beginning of an exciting new chapter for our business. We want to just obviously thank all of our clients for their patience as we've gone through this very thorough process of finding the right person to take the helm of what is a very dynamic and exciting business. I just want to give clients obviously comfort that the investment team has remained stable and consistent and remains in place through this transitionary period. So your investments have continued to be managed the same way that you would be accustomed to. And the performance, which we're going to give you an update on during this Q&A conversation, you'll see for yourself the team remains in very good shape, and the way that we're delivering those performance and returns to clients remains in place.
Yeah, and a very exciting time for the Satrix business, and I think for the indexation industry as a whole. And there's a lot of movement, a lot of action, if you can call it that, in the industry at this point in time. Recently, we've seen some consolidation in the industry, Kingsley. Do you expect to see more of the same continuing or going forward?
Yeah, there has been consolidation, and definitely I think that is going to be a feature within our industry, and particularly within the indexation segment of our market. Perhaps the first thing to mention is that Satrix is the leader in our industry with our AUM under management of about 160 billion. That puts us very much at the forefront of leading the indexation segment of our market. And I think what's quite important about that AUM number is not necessarily the AUM in totality, which is an important characteristic, but the fact that 75% of that AUM comes from third-party clients, the clients we're speaking to today predominantly. And that's important because our business has built up in being able to serve a variety of different client needs. And our business has been set up to service those different clients' requirements in an optimal and an efficient way. But yes, certainly I do think that some of the smaller players in our market are going to need to find ways to grow their AUM, because it's very much about about having scale. And managers that don't have that scale are going to need to find ways to achieve that scale to remain viable businesses going forward, given where fees are at the moment.
So indexation lends itself to consolidation very much, Gielie. So that's why we believe certainly there will be more. And at the end of the day, it's our clients that's going to reap the benefit of that.
Yeah, so Nico, you're very active in the field, as your title says, head of portfolio construction. So we often see clients together, and we get drawn into, or you get drawn into, this debate about active versus passive, and it's almost like this is this massive rivalry, the one, compared to the other, or the one is better of the other. Obviously, Satrix being a big indexation player in the market, what is your view on this active versus passive type of arguments that we often need to answer or get involved in?
Gielie, that's a great question. I think you've been attending some of the conferences that we've been presenting at, because this is this is something that we've quite actively, excuse the pun, been putting in front of the market and asking the question: should we be having a an active-passive debate, or is this just semantics? Certainly from our perspective, we see the active-passive debate more along a nuanced spectrum of rules-based versus active. And so what you see at the end of the day is that you have a equation of beta versus alpha. On the one side, you have vanilla indexation funds. These track market cap weighted indices. So this is your CapSwix, your Aussie, top 40 index. Now the benefit of that is you have transparency, you have controlled turnover, so you have lower turnover and lower expense ratios. Second, then, and this is where the nuance comes into play, is you have non-vanilla indexation. And so the term passive does not really encompass the difference between vanilla indexation and non-vanilla indexation. It kind of clumps it all together. But within the non-vanilla indexation space, we have factor funds, so we have single factor as well as multi-factor solutions. But then we also have thematic funds. And within this mega trend theme that is expanding, and certainly we're expanding our own offering to our clients, that falls under the non-vanilla indexation category. And then, of course, on the other end of the spectrum, you have your alpha-seeking actively managed funds. Now, of course, you have the ability to outperform the market, and certainly that promise remains, but at a cost of higher expense ratios, typically slightly less transparent as well, and less consistency in terms of styles. So certainly where we see a lot of opportunity for our clients is within the passive space, if you like, or indexation space, is to further refine how they think of index strategies, and also consider some refinement there. Consider factor investing as well as thematic investment styles.
Yeah, so Kingsley, we've got the three categories there, the vanillas, the non-vanilla, the actively managed funds. And let's be honest, the exciting stuff and where a lot of innovation takes place is the non-vanilla and actively managed type space. But does it still make sense, and where would it be relevant to utilize a vanilla index?
Yeah, so I think to answer that question, we need to talk to the concept of the arithmetic of active management. So I'm just going to skip forward to that section in the slides. And before we get into what may sound like a complicated topic, it's actually, let's introduce you to the originator of that concept, which his name is William Sharp, more affectionately known as Bill. And he's actually a Nobel Prize winner in economics, but he published this paper called The Arithmetic of Active Management in 1991. And very simply, what he said is that the investors are going to essentially get a return. The sum of all investors' returns is essentially a zero-sum game amongst all market participants. For every outperforming rand or dollar in the market, there's going to be another rand or dollar that underperforms. So all of those returns are going to be distributed around the market benchmark, which represents that universe of opportunity. But very importantly, that distribution of returns is on a before costs basis. So all investing, as we know, incurs costs of one form or another and at multiple levels throughout the value chain. So when you start adding costs to your realized returns or the returns that are potentially available, that whole distribution now shifts to the left. So what you then find is that your median manager, the return of what, the central point of that distribution of returns, is now shifted to the left on an after-cost basis. And what that means is that the percentage or proportion of funds or rands or dollars that are outperforming the market benchmark is actually a minority of the returns available in that spectrum. So what it shows you that is, to the extent a fund tracking a market benchmark is more cost effective than the range of actively managed or other funds available in the market, you're going to be somewhere above the median manager. So that's really what the arithmetic of active management is all about, and why tracking a market cap weighted benchmark would make sense.
Nico, anything to add to that?
Yeah, so we have some fascinating slides just in terms of making a distinction, right? Because what Kingsley is now mentioning is the vanilla indexation alternative, or the benchmark, the cap-weighted benchmark. And what we see is today, it's becoming a bit more nuanced in terms of how we define these benchmarks, right? So we all know there's this open debate of whether the Aussie or the CapSwix or the Swix is the most relevant benchmark. But actually what we're seeing in this slide shows it quite clearly, is that there's a growing similarity between the Swix and the Aussie methodologies. And so certainly from an active share comparison perspective to the all-share index, certainly the capped SWIX the all-share index is more similar to the CAPI, just by virtue of the CAPI capping the all-share index. But what you see, interestingly, at the top there, the yellow and the red lines, you see the SWIX becoming more closely aligned to the all-share index. And that's due to the inward-listed stocks, the grandfathered stocks, now diminishing in terms of their impact. So the difference between SWIX and all-share is reducing over time. Certainly something else to keep in mind when you do look at these benchmarks is where the returns are coming from. So we're actually seeing that the all-share and the CAPI, the majority of their returns, about 2/3 of the returns for the companies in the all-share index comes from offshore. Again, due to methodological differences between the capped SWIX, the SWIX and the ALSI, where the ALSI has a higher upweighting to foreign inward-listed companies and less so for the SWIX. So you do see a higher offshore earnings revenue coming from the ALSI. And so what this means is that there's a different type of payoff for the SWIX versus the ALSI, and certainly something to keep in mind for our clients. We showed on an earlier slide that we skipped, but the concept applies. If you look at the difference between active and passive, and to our earlier point, the tracking error of the capped SWIX to the median active manager in South Africa is the median active manager's tracking error to the capped SWIX, about 6%. And what's interesting is that the top 40 index has a tracking error of about 6.5% to the capped SWIX. So in other words, the top 40 index is a more active choice compared to the capped SWIX than the median active manager. So we're seeing that the lines between what is defined as active and what is defined as passive is becoming blurred. And so it's becoming all the more important for our clients to understand where the returns are coming from when we talk about vanilla indexation.
Thank you very much. Recently, changes, Regulation 28, hot topic. Our investors are often asking us, what are we doing about that in the active space? And indexation, I suppose, is the same. You've got the multi-asset funds. Nico, at this point in time, can you give us an idea of what has changed in that fund? How do you go about it? And what is that allocation looking like going forward, if you made any changes or proposing any changes on the back of Regulation 28?
So great question, Gielie, and I think it's important to, again, just stress the nuance there, and I think this is an important consideration for our clients as well. When we think of indexation in the balanced fund space, we oftentimes think, traditionally 60-40 allocation. It's as simple as that. But of course, it's not as simple as that, and there's more work that goes on in terms of defining our asset location within a balanced index fund. So while a balanced index fund, by its nature, by its the benefit of having a balanced index approach or an index approach to a balanced fund is that we focus on the medium to long-term asset location side. And what you see on this slide, and it's quite interesting how pervasive this is in the literature, how this has been proven to be the case globally, is that the dominant force in where returns are coming from a multi-asset portfolio is that it comes from broad market exposure, in other words, the strategic asset location side, and then also strategic factor exposure. So in other words, taking that factor tilt within your asset classes. By far the minority of what drives your returns is coming from timing, factor and market timing, so moving in and out of positions, in other words, tactical asset location, far greater minority, and then also security selection within the asset classes. So I just want to preface that your question by saying that it's incredibly important to understand that the majority of the returns coming from, or where the majority of your returns coming from, comes from the strategic asset location side. So this is why we take a very serious approach to considering it very carefully. We do a biennial, sorry, I always get that word wrong, biennial review, where every 2 years we revisit our asset location. We do a lot of research. We consult all various different teams in Sanlam, get inputs from the economists and various other stakeholders, and we collate all of these inputs, and then we do quantitative work, and then we combine the quantitative and the qualitative assessments to arrive at our ultimate asset location. So before we get into discussing some of our interesting findings, just want to preface that this is our focus very much on the strategic asset location side.
Yeah, and I'd like to just add on this particular slide is, knowing that the core driver of your multi-asset portfolio is coming from your strategic asset allocation, and in addition to that, the style of investing that you might adopt, particularly within equities, and only a minority of returns or a small portion of potential value add coming from those additional sources, it's very important to ask what you're paying for, which at Satrix is why we focus on those core drivers of portfolio and charge a much lower fee in our multi-asset balanced fund solutions, because that's primarily where you're going to get the value, and that's exactly why we focus so heavily on reviewing that strategic asset allocation once every 2 years, and similarly why we have a multi-factor strategy at the heart of our balanced funds, providing that enhancement of return in the multi-asset framework.
Okay, so Kingsley, on that, you are proposing or made recent changes to these portfolios. Can you give us some insight into that and how you get to that? Because with all the other webinars, we've heard how difficult it is to get your strategic asset allocation right. So you've explained the process, obviously a very thorough process and very active process, quite interesting. But what's the outcome of that? How does it look for our investors at this point in time going forward?
Yeah, so I think to Nico's earlier point, we review our strategic asset allocation every 2 years. It gives us a very systematic way and disciplined way to ensure that the design of our multi-asset funds is optimal in order to achieve those inflation-beating returns that investors are expecting by investing in those products. So the way we approach it is, firstly, by, as Nico said, meeting with the various experts across different asset classes, across the Sanlam Investments business. We get economics input, we get fixed income input, we get active views on different asset classes, and through that process we do a bottom-up build-up of what expected returns are for each of the asset classes. We go into a lot of detail to formalize and crystallize what we expect the long-term, medium to long-term returns to be for each asset class. In conjunction with that, we also look at historical realized returns, and those get put into an optimizer along with the way in which those different asset classes interact with each other, the way they correlate or are anti-correlated with each other, as well as the volatilities that those asset classes deliver through time. So what this chart and slide is showing is what the optimal weights are within a high equity balanced fund on the left and within a low equity balanced fund on the right, using our expected returns. So what's quite interesting on this chart is if you look at the chart on the left, you'll see that SA equities are very much favored within a high equity balanced fund, and that speaks a lot to the expected returns that we expect to come from local equities, given that our market has been trading at quite a discount for reasons that are well known to our investors. You'll also see that a big contribution is coming from local nominal bonds. So that would be something like tracking the Govie or the All Bond Index. So you get a big chunk of returns coming from that. What's interesting is when we start looking at offshore, what the optimizer likes. And you'll see that brown shaded area in the chart on the left actually refers to global infrastructure. So this is listed global infrastructure. Quite interesting that it likes it more than your global equity universe, like MSCI ACWI, for example, or MSCI World. And the reason the optimizer likes it is because it's a naturally defensive asset class or naturally defensive equity strategy. If you think about global infrastructure, what are you getting with that? You're getting a revenue source and returns and earnings that are a natural hedge against inflation, because those infrastructure assets are often tied to what the CPI will be within whichever economy they're operating. So as inflation ticks up, so their revenue will tick up in line with that, because that's the way those assets are typically financed and structured. So certainly on the more defensive side, so just to explain this chart, at the bottom you've got the expected returns, or the mean of what those returns for a multi-asset framework would be, and then the numbers in the boxes, in the rectangles inside the chart, refer to the standard deviation or the volatility of a multi-asset framework. So obviously as you move to the right, your returns go up, but so does your volatility. So what's interesting is towards the left, in a more conservative portfolio, you see a much higher allocation to global infrastructure, and it speaks to those defensive qualities that it offers and that natural hedge against inflation that you want in a portfolio. As you move to the right, you start moving away from global infrastructure and then start allocating more to global listed property. And that's quite interesting because we actually had an Index More webinar in conjunction with BlackRock when we launched our global infrastructure ETF. And we had an expert from FTSE who was involved in the design of this global infrastructure strategy. And they actually made the point that a lot of these assets are not highly geared in the infrastructure space. It might be somewhat counterintuitive, but we actually see that coming through in the asset allocation that our optimizer is favoring. So more defensive assets towards the lower volatility side, but then as you move up the risk-return spectrum, you start switching out of that into more aggressive leveraged strategies, which is what listed property is. So you see that switch out of the brown into the yellow, allocating more to global property. So we don't adopt what this optimal outcome is for a particular risk-return solution, but we use this process to inform what changes we want to make to our strategic asset allocation.
It guides our thinking in a way, because this provides a nominal anchor for us, a quantitative anchor with which to have these debates, like Kingsley's saying. And this adds a new element to our research. It provides a quantitative measure to actually put some numbers to these. And also interesting to what Kingsley mentioned about global infrastructure as an asset class is that it is acyclical, right? So if the economy is struggling, or let's say there's an economic downturn, there's not a reason why infrastructure companies themselves would struggle. In fact, on the contrary, we're seeing more and more that governments, especially in developed markets, are trying to fill the gap in economic output by actually investing in infrastructure. So you're going to see the G side, the government spending side of GDP, actually start to increase. And the easiest outlet for that is in investing in infrastructure. So certainly going forward, with all the economic uncertainties, with all the unknowns that our clients are facing, we see infrastructure as a great opportunity to add upside and that crucial diversification element in global equities. So we are increasing our global equity or our global exposure, but just doing so in a more cautious way, I suppose.
So to answer your question, what are the changes we've made? Let's flick to that. I'm going to come back to this slide in a second. I want to just show you how we use that information and what that's then culminated in. So this is our multi-asset high equity, sort of the high equity space, so where our Satrix balanced index fund would operate. The red box on this chart refers to our old or prior strategic asset allocation, and the green box refers to the revision or the revised asset allocation. So what you can see is, firstly, the fund or the SAA was pretty close to the efficient frontier, but we have optimized that further by reducing the overall volatility, and that's as a result of lowering our local exposure and increasing offshore exposure, as well as introducing asset classes like global infrastructure. Similarly, on the high equity side, you can also see the current or the prior asset allocation was right up against the efficient frontier, but we have been able to enhance that slightly more by reducing volatility marginally, but improving the expected returns with the changes to the asset allocation. So I'm just going to go back to this slide, which shows what those changes are in the Satrix Balanced Fund. And by the way, we implemented these changes now in June, so these are now effective. You'll see about a 10% increase to global equities, to global overall, a slight reduction in local equities. So those are the big changes, and you'll see the inclusion of global infrastructure and global listed property within the Satrix Balanced Fund. On the Satrix Low Equity Balanced Fund, changes are somewhat more minor. We've also included global infrastructure and global property on the offshore side, but we haven't increased the overall offshore allocation significantly. So that's been funded primarily by reducing the exposure to MSCI ACWI. We've also significantly increased allocation to local bonds, given how, particularly in the defensive space and the attractive real yields that you get from nominal bonds, it makes sense to allocate to that rather than, say, allocating to local listed property, which is one of your most volatile asset classes. So those are the changes we've made.
Guys, that's fantastic. You've done a lot of work. This is the theory. It looks great. Obviously, we need to see the performance or the numbers coming through. Our investors, the want returns, how has it played out for these balanced funds?
Yeah. So this chart, I think, picture's worth 1,000 words. So I should maybe just pause and let everyone soak the information in that's being presented here. But just to explain what this chart represents, the dark blue bar is our Satrix Balanced Index Fund on an after-fees basis. And the number at the top of each bar represents the annualized return over those different periods. The number at the bottom of each of those blue bars represents the fund rank over that period versus the number of funds in the category overall. So if you have a look over 5 years and 7 years, you'll see that our fund is very much in the top decile of performers versus any fund in the multi-asset high equity category. The light blue bar represents where most investors have money invested. Those are the 10 largest actively managed funds. They probably represent about 70% of the assets in that multi-asset high equity category. So relative to active peers, our fund has performed extremely well, but also relative to our direct competitors, other rules-based or passively managed or indexed balanced funds, which is represented by the yellow bar. We've also outperformed those. And that is coming from our regular review of the strategic asset allocation, following that in a disciplined way, not trying to get cute and clever by trying to time markets, sticking to a disciplined strategic asset allocation approach, but making sure that that SAA is optimally designed has enabled us to add value. And obviously Smart Core, as the secret sauce within our balanced funds, has created that differentiation versus other rules-based funds. And we see the same on our low equity balanced funds as well. We've made a number of improvements over the years, over the last 4 or 5 years, such as including enhanced yield within the way this fund is managed, and over the last year also introducing Smart Core as the equity strategy within our low equity balanced fund. And you can start seeing that value coming through in the performance of our fund versus those other peer groups.
Just want to say, add as well that this excellent performance has come during a time where historically there's never been as high an opportunity for alpha-seeking funds. So in other words, what we see is that the alpha opportunity in the market, the differential in returns between the different asset classes, have never been higher, right? So the opportunity to actually differentiate yourself from your peers has never been higher. And so it's really interesting to see that despite the high premium to getting tactical asset allocation calls right, we still see that funds that focus on the long term, the medium to long term, the strategic asset allocation, in other words, focusing on the asset location, not within asset class distinction, is still proving to be a deciding factor. And so, if you look at it from a medium to longer term, 3 to 5 year basis, it becomes incredibly hard for active managers within the multi-asset space to add that value, simply because our costs are so much lower, management costs as well as trading costs, because we do not actively seek to tactically change our asset location frequently.
Yeah, thank you for that. I just want to change tact a bit, and let's talk about, you've got a very broad product set. We spoke about it right through vanillas all the way up to these balanced fund or multi-asset funds. But you also provide different vehicles, Kingsley. I mean, it's between ETFs, unit trusts. How do our retail clients actually access these products?
Yeah, so it's a great question, Gielie, because historically we had different products and different vehicles to service different clients or types of clients. So clients that might have a financial advisor and have their access their investments via a LISP platform would need a unit trust in order to access those strategies. Whereas clients that wanted to trade intraday or access their investments through a brokerage account and trade directly on the JSE, they would use an ETF. And then often there wasn't an exact mirror of unit trust strategies to ETF strategies. But that has largely now been solved with us making ETFs available on the LISP platforms. So ETFs are coming to a LISP near you. We've already rolled them out on a couple of LISPs like Glacier, and there are a few others where a wide range of our ETFs are available. So there's going to be increased choice whether your assets are managed, through a financial advisory model on a list platform, or whether you're doing it yourself. You can access the full range of investment strategies that Satrix offers. And perhaps just to, what I'm showing on the slide here is just the breadth of that range from vanilla, what Nico was talking to earlier, where we've got a wide range of vanilla strategies offering beta exposure to either the broad market, such as our capped all-share ETF, which was launched late last year. And by the way, that's running at 0 TER until the end of this year. So that's something to definitely consider. Or subsets of the market, whether it's a sector play or the top 40 stocks. Moving into the factor space, which is also what Nico was talking about earlier, and then on to megatrends. So a wide range of investment choice. And I think this really talks to the whole democratizing of investing and making more choice available to investors, and to allow financial advisors and DFMs and portfolio constructors to use those different levers to create solutions to meet client needs.
And also, sorry, before we just want to, on the global side as well, and this is especially where our offering has expanded quite a bit. On the vanilla side, again, you have your MSCI World, MSCI EM, Global Ag, etc. And then we're also expanding our range quite a bit. So those of you that have kept an eye on these things and seen what we've put out there, you'll see that our range has expanded quite dramatically. And this includes sort of country exposure, so S&P 500, MSCI China, as well as MSCI India, but then also the mega trend theme. And so what we're offering here in terms of ETFs is great exposure to our clients to have easily accessible ETFs where we have a feeder ETF structure that with our partners iShares, so BlackRock's iShares indexation business, the largest index tracker in the world. And we are designing, doing all the heavy lifting, regulatory and tax-wise, to get these funds listed in South Africa, these ETFs trading, and they then feeder ETFs. So they feed directly into all the research and compliance and all the additional benefits that you get with the scale of an iShares. You remember, so earlier we spoke about scale and how indexation is all about scale, right, and efficiency. And so partnering with them and having access to their funds and bringing that to South Africa, what it's doing is it's expanding the range that our clients can have access to, and certainly intermediaries can then design more sophisticated portfolios at a low cost. And so we see this as tremendously as adding tremendous value to our local market, and specifically at the end of the day, our clients are going to reap the benefits of this. But we're always happy to engage with our growing offering. We certainly, recently I read an interesting article where someone was quite critical about expanding the range of indexation. In other words, bring it back to more simpler days, right? Indexation is all just about vanilla. Passive should be passive and nothing more. And so this is an interesting debate, right? And I'd be curious as to our clients what their views are. But at the end of the day, we see that as missing the point, right? Because indexation offers so much more. It's not simply a difference between passive and active. There's a nuance there. There's non-vanilla indexation that can add tremendous value. And so what we're seeing with the mega trends and our broadening range of offers, fund offering, is that this allows investors to just broaden their scope, add more diversification. Because within each of these different themes, it's really an exciting way for clients to access medium to longer term opportunities at very low costs and great scale and efficiency.
Yeah, you mentioned a couple of things that I really want to touch on, but I just want to backtrack a bit to the ETF unit trust debate as well, is that it's very important for our intermediaries to understand that when we say you can access an ETF on a platform, it looks like a unit trust, it reacts like a unit trust. You can co-invest it in your wrap funds or whatever way you allocate to those funds, similar to your unit trust, which actually takes complexity away. Because what we still find is that people still think you need to access it through a BDA account because it's a listed instrument. You need to have different licensing. In our world, if you register to sell a unit trust and can place it on a list platform, you can access these ETFs. And I think that's the beauty of it. Although it sounds very complicated, from an entry point of view, we've made it really, really simple. I just want to go back. We touched on the vanillas. We touched on that benchmark gap. And to be honest, when I started engaging with you guys on it, it becomes really complicated, like you said, even just in the vanilla space. But Kingsley mentioned it, you launched the CAPI last year. Don't we have enough local vanilla indices? And what was the reasoning behind that, Nico?
Yeah, so CAPI is interesting because this offers an opportunity for clients. So first from what Kingsley mentioned, I mean, at the zero TER, the tagline, if you like, and we're not that into taglines, but if we can have a tagline, I mean, you're getting the whole market for free, right? So the difference between a CAPI and a top 40 is certainly the small cap exposure that the CAPI offers. So remember the difference, the top 40 is just 40 stocks. The CAPI is the entire universe. So the idea is to provide exposure to more than what is traditionally provided in these vanilla market cap indices. So, our top 40 ETF and unit trust, I mean, this has been trading for 20 years and everyone knows it. But the CAPI offers something different. Just in terms of its return profile, and I think, it's useful to consider the CAPI versus the top 40 versus the S&P 50. What you see is that the returns over time on a rolling 36-month basis, you can see on the screen, is quite similar. But what the CAPI offers is this increased exposure to the small caps. And our research has shown, and at home you might find this quite unintuitive, is that the small caps is actually adding within its group, right? If you compare large caps and small caps as groups, the small caps actually offer more diversification and higher returns at a lower risk. So, and the reason being the large caps is more exposed to the volatility of the rand because more of the large caps actually earn their revenue from offshore. So you see more return variation in the large caps as compared to the small caps. So certainly adding that small cap exposure to your large cap exposure, which the CAPI does, is actually reducing volatility and adding upside potential. And we've seen that. Recently the CAPI has done extremely well. And on a rolling basis, if we just look at so what this slide shows, and apologies if it's a bit busy, but it's quite intuitive to interpret. The black or the dark line in the middle, the gray line, that's the median active manager returns on a rolling 3-year basis. Okay. Then the dark shaded area, that's the bottom and top quartile, so the 25th and the 75th percentile. And then the light blue, that is the top and bottom decile. So those are the absolute rock stars in the active management industry. Now, what we see is if you look at it on a rolling 3-year basis, we show the performance of the CAPI and the top 40 index. Now, this is a net of fee exercise, so we do subtract 30 basis points fees to both of those indices to put it on like-for-like comparison. And what's interesting is if you look at the performance of these two broad indices compared to active managers, very seldomly do they actually on a medium-term basis, on a 3-year basis, underperform the median active manager. In fact, in recent years, since 2017, both the CAPI and the top 40 has been top decile performers, if not comfortably within the top quartile range. So certainly there's opportunity there, and it's becoming harder and harder for active managers to outperform these indices on a after-cost basis, but also in terms of the composition. So there's opportunity, and we're providing this opportunity to our clients, and we are not bringing the CAPI to market just for the sake of expanding our range, but because we believe this additional exposure to the small caps might be something that's useful to some of our clients.
Great, thanks, Nico. And just now, forgive me for saying, but you were very quick to jump to the global themes, and it sounds like you're very excited about it, because that is the exciting stuff going on, global trends coming across, a lot of themes coming through. And one of the themes that frequently comes up is this technology and innovation. Can you give our audience an idea on how you capture that and how they can access those type of themes?
So let's technology is a very interesting mega trend because I think it's one of those, and just want to make a quick semantic point that when we talk about mega trends and thematic investments, we tend to talk about them interchangeably. But how we see both of these concepts is that mega trends are kind of the undeniable forces that we see globally, right? So a move towards a more tech-orientated economy, demographic changes, shifting of economic powers to the east, and various mega trends that are almost inevitable. Thematic investing is trying to create portfolios that invest in these mega trends. Now, there's the nuance, right? There's the art and the science as well, is in actually designing these portfolios to meet that. Now, within the technology theme or mega trend, what we offer is the NASDAQ 100 index, so exposure to that, which is the preeminent tech play, if you like. So these are the largest tech industries, so they are well-known and sort of established companies that are at the cutting edge of technological development. Now, an alternative to this would be, for example, the S&P Kensho New Economies Index. Some of you might know this index as well. And it's interesting to compare the return profiles over time of these two indices, right? Because, and again, this speaks to the nuance within thematic investing, is that you might think that tech is tech, right? So whatever you track is irrelevant if you want to track the mega trend. What we say is there should be more caution here. And if you look at the return profile over time of the NASDAQ 100 to the S&P Kensho, on this slide we show it on a cumulative return basis. What is interesting, though, is if you look at the 250-day volatility on aggregate, right, you see that the S&P Kensho has a much higher volatility, right? And you do see that in the previous slide in terms of returns. It shot the lights out post-2020, but has since corrected very sharply. So there's a higher volatility to it. And what's interesting is if you dig a bit deeper to see where the returns are actually coming from, because we need to ask the question, right, where's the returns coming from? If we look at the S&P 500, now this is just looking at factor attributions for the three different strategies. So S&P 500, that's just vanilla. This is the large US index. What you see is that a large component of the returns are actually explained by momentum, profitability, and then quite a size component to it as well. Look at the NASDAQ. So the NASDAQ, interestingly, in recent months has actually gotten a bit of a negative momentum and negative value, and this is what we've seen. We've seen a strong correction in the tech industry, so there's no surprises there. But certainly what we've seen as a constant theme throughout the quarters is that the NASDAQ index gets a high profitability as well as a high growth component to it. So in other words, there's enough good stuff in there to actually validate its consideration. If we look at the S&P Kensho index, what's interesting is that you see a very sharp negative momentum exposure, very sharp negative profitability exposure, a very high vol component, and then a very strong low size or small size component. Now, looking at this across now, you can see that the key difference between the NASDAQ 100 tech portfolio and the S&P Kensho alternative is that the S&P Kensho is smaller companies that generally have lower profitability ratios and oftentimes slightly lower growth components to it as compared to the NASDAQ. So the NASDAQ is the safer, larger, more established way of picking up the tech trend. Maybe just reverse a second. All of these factor exposures that we look at is Bloomberg's definition, so it's not our definition. So this just provides an objective lens to where the returns are coming from. So we'd always caution our clients, when you're investing in tech as a theme, consider what alternatives there are and ask critically the question, where are your returns coming from? And if it's coming from a small size, counter value, counter profitability play, there's times where it's going to work, but there's times where it's going to strongly fail you.
Great, thank you very much, Nico. And I think you mentioned it's around the definitions, and the intermediaries need to understand the definitions. I mean, I'm not going to expand and ask you questions around, but it's the same with quality, value, momentum. There's nuances in the definitions, and your definition might change slightly from some of the other offerings, and it's important that our intermediaries do understand that. But Kingsley, we've touched on a lot on the vanilla indices. We've touched, on the ETFs and the themes. But now also, I would like us to spend some time on how does it play out. We touched on international factors, factor investing. Does it work in SA? I think that's the first question. We get a lot of criticism. Our market's too small. It's this, it's that. A lot of different opinions around it. Does it work, first of all? And then secondly, that comes back to the normal debate. How does the numbers stack up when you compare it to the bigger active managers? Because that's the other debate we normally enter into. Yes, but our market's different. The bigger active guys dominate the space, and it will be like that, and the indexation players can't compete with it.
Yeah, so look, I think let's firstly start with vanilla, and then we'll move into the factor space. So we spoke a little bit about capped all share and the arithmetic of active management. This is some fascinating work that Nico's done. So looking at the returns from our equity market, from the equity sector in the ASISA category. These are all the SA Equity General Funds. And so what we've done on this chart is looked at all of the 3-year returns over the last 20 years and put them into different quartiles. So, and compared that to how the capped all-share index has performed, which is that 0 dotted line that you see in the middle. So what you can see, and to sort of empirically confirm that the arithmetic of active management does actually play out in practice, you can see that the capped all-share index, after costs, we've deducted 50 basis points of fees so that it can be comparable to a net of fees return that a unit trust is delivering. On an after-cost basis, you are outperforming the median manager 84% of the time, and you're getting top quartile returns almost 30% of the time. So yes, vanilla indexation on an after-cost basis does work. It does add value. It does realize a compelling investment case for investors that might be considering it. Nico's also done some work. Maybe you want to elaborate on this slide.
Yeah, what's interesting about this is, so we've looked at it on a zero fee class. So the previous slide that Kingsley showed is now after fees, and certainly the point is well made. And theoretically, we know that after costs you underperform the market. So that's sort of an intuitive understanding. But this is less intuitive. What we then did is we took all the zero fee classes. So in other words, this is before fees, right? And we look at the performance of active managers compared to the CAPI before fees. Now, what's interesting is that red distribution there, the median distribution is still to the left. Now, this is less intuitive, right? Because this is now without fee consideration. So what this is telling us is that on aggregate, active managers are adding costs in addition to just the fees that they charge. And this is trading costs, this is trading inefficiencies, selling too late, buying too early, well, vice versa. But you know what I mean, right? So all of this action in the market is actually putting the brakes on slightly. So we see that before fees and after fees still, you're shifted to the left. And so this makes a very strong case for considering vanilla indexation as part of your portfolio, certainly. We also see that if we just dig a bit deeper, right? Because an interesting retort that I've heard many times, and certainly in our discussions with clients, we always hear this, is that yes, no, indexation works, but active managers are able, when the market corrects, right? So when markets are in a bear period, that's where active managers come to the fore, because they can then hedge that out and sell out of positions that are hurting, et cetera, and provide that downside buffer. So what we did is we took exactly the same approach, but this time just looked at the periods where there's been the bottom quartile of returns. So in other words, where the market as a whole has actually experienced poor returns. And what we see is that the distribution shifts even more to the left after costs and also before costs. So before costs are taken into account, just the gross performance, you still see that shifting to the left, and in fact more so when markets are experiencing worse returns. So what this is telling us, I mean, without getting scientific about it, but just intuitively, what this is telling us is that when markets are experiencing a correction, active managers, instead of doing the right thing, are doing something. And oftentimes that something that is being done might actually hurt you even more. And certainly we see that playing out in South Africa, that to be the case.
Yeah, and I think that was surprising in your balance funds as well, because you would think that with a strategic asset allocation being fixed for a period of 2 years, during volatile periods, you're going to be found wanting. And that wasn't the case when we looked at the numbers.
No, I mean, it's actually that systematic rebalancing back to the strategic asset allocation actually enforces a buy low, sell high discipline, which might otherwise be difficult to implement when you're shrouded with all the negative emotions of load shedding, for example, or corona lockdown. That was exactly the point that our fund bought back into listed property and bought back into local equities just at the bottom when they started to recover. So there's a lot of merit to following a disciplined rebalancing approach and sticking to your strategic asset allocation rather than trying to time markets.
I also want to make the point, and it's often when we talk about active versus indexation that the point can be missed quite easily, is we're not advocating for no active management. On the contrary, right? Indexation simply tracks the market index or a set of rules if it's non-vanilla. But we need active managers in the active management industry for their price discovery role. And certainly this is key. We're not advocating for a replacement of active managers by no stretch of the imagination. But what we're saying is that there's value in indexation. There's value in considering an approach that is disciplined, transparent, low cost, in addition to having active managers that can actually pursue this price discovery in an efficient way. We're just cautioning the fact, and you mentioned it earlier, these large institutions and they're dominating the market. Certainly that in South Africa we have a bias towards active management, but there's place for both. There's place for indexation. The numbers bear it out. Conceptually it bears it out. And there's naturally place for active managers as well. We just need to find a way where we can have a constructive debate. And we don't feel that squaring it off as a dichotomy between active and passive necessarily is a good way to do so. But certainly, trying to see where indexation fits in matters. On this slide, and I'm sure Kingsley would like to tackle this one, but this is now taking indexation a step further, right? Where vanilla indexation, we've shown you the performance of the CAPI, for example, relative to active managers, but what this is showing is now non-vanilla indexation. In other words, not passive, but refined beta. If you maybe...
Yeah, so, this is our Smart Core Index Fund, which is the underpin to both of our domestic equity strategies within our balanced funds. We have it as a standalone equity strategy in the general equity category as a unit trust, so it's available for any portfolio constructors to utilize within their solutions. If they want access to the strategy, it is available as a standalone equity. And this just shows you how it's performed versus CapSwix on an after-cost basis. So CapSwix here is the clean index, no cost deducted off that. The dark blue bar is the ranking of our retail class versus CapSwix. So you can see it's added value on a net of fees basis versus CapSwix, and how that has stacked up versus the industry overall, which is shown in the red bar, from a top quartile to median to bottom quartile perspective. So a great strategy for investors looking for enhanced returns relative to what the broad equity market's able to offer. And I think just on, talking on the value that indexation is able to offer, this is our MSCI World Equity Index Feeder Fund. We offer this in both unit trust form. We've also got an ETF which tracks MSCI World, and just again showing that tracking the broad market index, coming back to that arithmetic of active management. Look at the value that our MSCI World Equity Index Fund on an after-cost basis has added relative to any other fund you might be considering within the global equity general category.
Yeah, and maybe if I can pull Nico in here on the next thing is when you do portfolio construction, you've got when you have the discussions with clients, predictability and consistency is a theme. It's something that clients like because they know what the potential outcome is. They don't necessarily always want that volatility as for the big part of the portfolio. Like you mentioned, in the active space, yes, there's definitely components of your portfolio where you are able to have an appetite or accommodate certain levels of volatility, but consistency in terms of indexation strategies as a core type solution or part of your solution is key. And I think you've got a couple of slides that you've done work on that I would like you to expand on, please.
Yeah, certainly. So if I can just get to, let me take these slides in answering your question. I think, Gielie, the point that you made around consistency and transparency and knowing what you get is such an important point, because more and more we're seeing clients value that highly, prizing highly the fact that some of our strategies, our indexation strategies, are transparent, low cost, but you know what you get, right? And I think this makes a big difference. Again, just re-emphasizing the point of consistency, that consistent performance. Indexation on a one-year basis, and I want you to just look at the left bar. So what we do here is we take a few of our longest trading unit trusts within the different ASISA categories and just square that up with active managers, right? Just to see how consistent the performance of these different strategies are, indexation strategies. And what you see is oftentimes on a rolling one-year basis, for example, you see the outperformance is there, but oftentimes there's some underperformance, right? But the true value of indexation becomes clear and almost undebatable once we move from the short term to the medium and longer term. Now, what we see here is on a rolling 36-month basis, the Aussie Index Fund outperforms the median active manager. In other words, performs in the top half or top quartile, 73% of the time, right? Almost 75% of the time. It's only in the bottom half about a quarter of the time. So the majority of times you are outperforming the median over the medium term. If you fast forward that to 5 years, your outperformance of the median active manager gets closer to 98%. So this is where indexation really gets to its value, where the lower cost, the lower turnover, all those inefficiencies that you're removing by having indexation as part of your strategy really comes to the fore. And it's not only within our local equity range either. If we look at the Satrix Balance Index Fund, again, the exact same story emerges. On a rolling one-year basis, yes, there's going to be times where you underperform, and certainly we're not saying we've designed a silver bullet that will always outperform. But as soon as you move to the medium term, 3-year, 5-year numbers, the numbers don't lie, right? In fact, on a rolling 3-year basis, you're outperforming the median active manager in the balanced fund space 95% of the time. And in fact, if you look at it on a 5-year basis, we've never underperformed the median active manager in the, 9 years that we've managed this fund. So, and you're getting top decile performance almost 20% of the time. So certainly indexation, the value of indexation comes to the fore when we look at the medium term. Also, same with our Satrix MSCI World Equity Index Feeder Fund that Kingsley showed. Its performance, again, same story. If we look to the medium to longer term, you're outperforming the median active manager almost every time, and certainly you are in the top quartile. Now, what we want to set the expectation for our clients very clearly is that we don't necessarily believe that indexation will be the top performing fund or should be in the top decile necessarily. There are certainly active managers that provide tremendous value and that have the ability to be top quartile performers. We've just seen in the South African space that consistency in performance is strongly lacking. The point that you made earlier, your ability to repeat past performance and keep delivering that top quartile performance is very rare. And so what we advocate for our clients is consider indexation as the core, the staple diet in your portfolio, and identify those active managers that are able to outperform those indices. But certainly as an industry, we need to measure ourselves against indexation.
Yeah, I mean, maybe just to add to what Nico's presented is, we've obviously shown a couple of our funds and how well they've done over various periods, and that has really led to us for the second year in a row scooping what is I would deem the most prestigious award in our industry, the Morningstar Best Fund House for larger funds. This is an award that's historically gone to the flagship names in our industry, but we were quite surprised when we won it the first time in 2021. But then to have scooped it again 2 years in a row, based on our 5-year risk-adjusted performance, I think is very indicative of the value that clients have experienced in adopting what we offer to the market. And so, our success is very much our clients' success, and we want to thank all of our clients for their continued support of our business and the growth that we've experienced. Our process is very scalable, and the Satrix business is very sustainable in its own right. So we're going to be around for the next 10, hopefully 20 years going forward. So, yeah, thank you very much.
Yeah, gentlemen, we've run out of time. Thank you very much. I think it's always insightful for me to engage with you guys. I always learn a lot. And you often say, Nico, it's everything but passive, just like there's a lot of going on. And I want to invite our clients to engage with us, because it's not as simple and straightforward as you might think, or sometimes it's also not that difficult. And that's where you come to your own when we sit with clients and do portfolio construction. So from our side, thank you very much for joining us for this webinar. Thanks for spending the time with us. Thank you very much for your support during an extremely difficult time this year. We really appreciate it, and do not underestimate the value that you provide to your clients by guiding them through this difficult time. And until we see each other again, have a good day and goodbye.